Welcome to the first installment in the new series, Tim Black's Strategy of the Week. Today we're going to look at a strategy that works great with stock indexes, the 3 days drive strategy. Hi, this is Tim from TradingStrategyGuides.com. Thanks for being here for this installment of the Strategy of the Week. This is a new segment, and I'd love your feedback in the comments. Let me know if you think this video has been helpful and what you would like to see in the future. I'll still be doing the Trade Picks videos on Mondays. For today's strategy, we're going to look at the 3 days drive, a strategy that's been tested in the stock index markets. Also, stay around to the end of the video and I'll share a quick update of any changes in the Trade Picks. I mentioned that this strategy has been tested on the stock index markets. So just to be sure everyone's on the same page, let's talk about those markets for just a minute. For starters, I dropped a fancy trader's word on some of you who may be new to trading. A stock index is a market that buys and sells a basket of stocks. You may know a few of the big name indexes. And yes, the word indexes is a legitimate plural of the word index and is used mostly in North America. The rest of the English-speaking world may know that word as indices, but being a Yank, I'm going to continue to say indexes. Otherwise, my video editor is going to have a nightmare on his hand trying to correct all my tongue fumbles. I hope you guys are okay with that. Okay, where was I? Right, big name indexes, like the S&P 500 index, the NASDAQ index, and the Dow Jones index, the DAX, and so on. A stock index is essentially a representation or a benchmark of how the stock market is doing as a whole. Stock indexes are constructed by different rating agencies and are composed of many stocks. For example, let's take a look at the S&P 500. The calculation of an index consists of weighting the prices of various stocks before including them in the total. Here are the top 10 stocks of the S&P by weight index. And here is a zoomed-in picture of the S&P 500 stock composition by sector. Okay, enough about the actual indexes. If you want more info about them, click the links in the description below to the strategy pages at Trading Strategy Guides. Let's talk about trading indexes. Stock indexes move similarly to the underlying stocks. We like to say it's escalator up, elevator down, or stairs up and elevator down. Stocks always seem to drop faster than they rise, but it's purely an emotional reaction. The stock starts to drop and fear causes everyone to jump in and drive the price down like a rock. Knowing this gives us a little edge when it comes to trading stocks and indexes. To take advantage of this edge, we need to find an index that's trending up and waiting for it to pull back so we can buy into the next push up. So here's our strategy. Like any other strategy, this is not a 100% foolproof strategy. If anyone tells you their strategy is 100% foolproof, well, they're pretty much lying to you. At least in my experience, I've never seen one. It's your job as a trader to take the losses and move on periodically. So never abandon your stop loss no matter what. Develop your trading rules before you trade and stick to them as if your life depended on it. Because it does, actually. If you've followed my videos for some time, you may be familiar with my trading maxims. More specifically, Tim's trading maxim number 62. Make your decisions in advance of the emotions so you don't have to make them in the midst of the emotions. Plan your trades in advance before you click the Do It button and then follow your plan. Okay, enough with the psychological stuff for now. Here are the strategy rules. Rule number 1, look for a stock index in an uptrend. Let's take a look at the S&P 500 here as an example. Now, before any of you naysayers out there talk about cherry-picked examples and so on, and I know some of you are going to do that, yes, these examples are cherry-picked. If I did not cherry-pick these examples, then they wouldn't be very good examples, would they? I want you to see what this should look like. Not all charts are going to look exactly like this. Not all charts are going to look this good. But for the purposes of example, I'm using this chart right here of the S&P 500 from late 2019. So let's take a look at this uptrend right here. Now an uptrend, if you followed my trading education series, you know that an uptrend is higher highs and higher lows. This is an uptrend right here. You'll notice there are a few red candles in there. That doesn't change the fact that this is still an uptrend. Okay? We are going to look for a pullback from this uptrend. And we're going to do that by waiting for 3 consecutive daily red candles. You can see that highlighted right here. The 3 days ride. On the 4th day, wait for the price to pull back below the 3rd day candle. And it may or may not actually do that. What I'm saying is, it's okay if it doesn't, it's okay if it does. So this is the 1st day candle, 2nd day candle, and the 3rd day candle. The 4th day candle never does, in this case, actually get below the 3rd day candle. That's okay. It may push below there, and it may not. We're going to buy on the close of the 4th candle if the close is higher than the open. In other words, a green candle. And then we'll place the stop loss a few ticks below the swing low. So this candle opened right here and closed right here. So we're going to buy at that level right there. Our stop loss will be below the swing low. And it's kind of tough to see here, but it looks like the number 2 candle is lower than the number 3 candle. So we're going to put our stop a few ticks below that. How many ticks depends a little bit on your market. In the case of this S&P 500, I would probably put it 5 or 10 ticks below. And lastly, close the trade when the next closed red candle appears. So we entered the trade right here. The close of the next red candle is right here. So this is our profit on this trade. Now keep in mind that every one of these candles up through here was red at some point during its life. So don't close just because you see a red candle. Wait for the candle close to be below the candle open at the end of the day, and then close your trade. And that is basically the 3 days drive trade. There are possible modifications that you could make to this trade. If you prefer, you can look for only 2 consecutive daily red candles before the other rules. You're likely to end up with more trades, but a lower overall win rate. So for example, if you had taken this trade, your entry would be right here, and your close would also be in the same position. If you had taken this one, your entry would be here, and your close would be up here. So there was a little bit of profit in that one. If you took this one, your entry would be here, your exit would be here, a little bit of profit there, and so on. So obviously in this run up right here, there's 1, 2, 3, 4 2-day red candles and 1 3-day red candle. Here actually is a 4-day red candle. However, once you get 4 days down, the probability of it continuing in the original trend direction is less likely. Obviously, if you'd use the same rules on this one, your entry would be here, your exit would be here, and there would have been a little bit of profit in that trade. So those are possible modifications. Another possible modification would be, instead of closing on a red candle, place your stop loss a few ticks below the red candle and see if the price will continue in your direction. Here might actually be a good example of that. If you entered this trade here, price moved up, you normally would have closed on the close of this candle, but instead of that, place your stop loss a few ticks below that candle and see where it goes. It obviously pushed up. You got another red candle here, do it again. Now in this case, this candle would have stopped you out right here. But you definitely would have gotten more profit on this trade had you done it that way. The downside of that, of course, is that if you entered the trade here and you placed your stop here and then this candle pushed down and hit that stop, you would have made a little bit less profit on this trade. But one good runner could easily make up for that difference. Remember, trading is a personal thing. We all have our quirks and are comfortable with certain things and uncomfortable with other things. None of these rules are engraved in stone. However, and this is a huge however, you have to test your strategies. Testing your strategies serves two purposes. Purpose number one, testing your strategy will confirm whether it is a winner or not. And purpose number two, testing your strategy will help you to know whether it's a winner or not. Those two things sound the same, don't they? Really, they aren't. For starters, trading is based on probabilities, so successful strategy does not necessarily win every time. You can't run a strategy once and know whether it's good or not. Let me give you an example. If you have an intermittent problem with your car, let's say it won't start, but sometimes it does start, and you have no idea why it will or won't start or when it will or won't start at any given time. So maybe you're a mechanic and you tweak something and the car starts. Did you fix the problem? You can't know that. How do you know if you fixed the problem? You only know by starting it over and over and over again over time. When it starts every time, you can probably figure that you fixed the problem, right? Okay, that's the way it is with testing. The more you test and the better the overall win-loss statistics, the more likely you've got a good strategy, and that will satisfy purpose number one. At the same time, every time you execute the strategy and see that it is an overall winner, you're gaining confidence in the strategy, and that satisfies purpose number two. When you have confidence in your strategy, you'll continue to use it, even if you get the inevitable long drawdown period, which happens periodically. So purpose number one is to prove the effectiveness of the strategy, and purpose number two is to increase your confidence in the strategy. Okay, I did promise I was done with psychology, right? That's it for this week's Strategy of the Week, the 3 days drive strategy. Let's take a quick look at the significant trade picks for this week. Bitcoin has broken out of this consolidation in a major way right here. I've gone back to trailing stops. Got it trailed up to 11,658.50 right now, locking in 817.77. It is now Thursday afternoon, just a little after 2 o'clock New York time. The Australian dollar Swiss franc hit the first target right here. Got half off, moved the stop to break even at about 64.86. The euro Australian dollar triggered right here. Hit the first target right here. We got half off, moved the stop to break even, and break even was hit on the very next day. So that was a boom, 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 and we're done with this one for now. US dollar Japanese yen attacking our range right now. We're looking for a weekly close below this range. This could be the week, so take a look at it just ahead of Friday's close and see what's going on with it. The crude trade triggered a buy right here, a full-size buy above the 41.50 level, closed back inside the range. The very next day, I took the loss. The volume and volatility continued to decline, so I'm comfortable with redrawing this range up to 41.90. So we're looking for a daily candle close above 41.90 to buy this. And that's it for today's video. I hope you enjoyed the new Strategy of the Week segment. We'll be doing this every Friday. Be sure to come back next Wednesday at 3 p.m. We'll continue to discuss technical analysis in the Trading Education series. And don't miss the Trading Picks video on Mondays. Our videos come out on Monday, Wednesday, and Friday at 3 p.m. U.S. Eastern Time. Be sure to subscribe and hit the bell so you'll be notified when the videos come out. Have a great weekend, and I'll see you with a trade pick on Monday.